Alright, hi guys. So if you recall, on the 23rd of October, I published this video where I said that the stock market rebound was incoming because at the time, the S&P 500 was way oversold after it did a double bottom pattern where it retested the lows of mid-June, and I said that price action is suggesting we're going to have a rebound. So we've had that rebound. The market is up 10% so far from those lows. So now that we have rallied up 10% from those lows, we are coming to a critical point in the markets. The moment of truth is coming. Why? Because we are approaching this very strong level of resistance. Let's take a look at this chart. So you can see on the daily chart, you can see this very strong downward trend line that started at the start of the bear market over there. So you can see this very strong trend line that also happens to coincide with the 200 moving average. So we're getting near to that trend line. So again, a lot of people are asking, hey, are we going to hit that trend line and we're going to go back down again, or could we break above this trend line and could we in fact be at the start of a new bull market? Let's take a closer look. A reminder that all my courses and playbooks are going for up to 75% off for a very limited period of time. So go on to piranhaprofits.com and grab your favorite courses, whether it's the stock trading course, the value momentum investing course, the option courses, or the price action manipulation courses that's going to give you the skills and knowledge to succeed in today's markets and join our private community of traders and investors. Now, a lot of people would be asking, hey, is this a bear market rally or is this the start of a new bull market? At this point of time, we don't know yet. We have to wait for the bull market to confirm. So for now, it is still a bear market rally because it is still a bear market. Remember, by definition, a bull market only begins when the S&P is able to rise 20% above its lows, which is there. That's the low, right? So where's 20% above the lows? Use your measuring tape over here. You click on the lows and drag it all the way to 20%. So I'm looking for 20%. There we are, 20%, which would be at 4,000, roughly about 4,200 points on the S&P 500. So in other words, the 4,002, this over here, let me get rid of this line. This would be the critical level. So if the S&P 500 in the next couple of days or weeks, if it can break above this level of resistance, this downtrend resistance, and it can close above 4,002, by definition, that will be the start of the new bull market and the end of this bear market. So again, has not happened yet. Right now, we are still in a bear market rally until proven wrong. So the question would be, then you'd be asking, hey, do you think, Adam, we can break above this trend line? Now, no one knows for sure. No one can predict the future. We can only guess. What I can say is that this time, things are a bit different from this time and this time. So the first time we actually hit that resistance, we came down. We hit that resistance, we came down. And now we're going for that third test, right? So there are certain things that are now different. The first thing that is different now is that the Fed has begun to say that, you know what, we are going to moderate the rise of interest rates. Now, remember that this entire bear market happened without a recession. There's no recession and there's no earnings contraction. So this bear market is purely caused by the Fed raising rates too aggressively. It was engineered by the Fed. So like I said previously, the Fed does not have to cut rates for the market to go up. They don't have to stop raising rates for the market to go up. They just have to slow down their rate increases, and that will create that that will cause the market to go up, right? So is that happening? Well, according to what they say, yes, because let's check this out. This article just came out, let's see, on the 2 days ago on Friday. Fed officials, finally they see smaller rate hikes coming soon. So based on the Fed minutes, now the committee is saying that, you know what, we're still going to raise interest rates as we project, but we're going to slow down the increase. Instead of raising by 75 basis points, we're going to raise by 50 basis points in December probably, and then 25 basis points next year. So this is a shift in the Fed language, right? And what happened since they said this? The 10-year Treasury yield is now looking like it's breaking down. So remember that as the Fed raised rates aggressively, the 10-year Treasury yield has gone up really fast, and that has caused the market to come down. But now, the opposite is happening. The 10-year yield is beginning to break down. It has now closed below the 50 moving average, and it's looking like it's coming down. So this could be the fuel that potentially pushes the market or the S&P 500 to be able to break this trendline resistance. Again, we have to wait for confirmation of the charts to show that it is happening. In trading, you can have a thesis. You can say, this is likely to happen based on my thesis, but you have to wait for the charts to confirm your thesis before making a move. In other words, we don't know until we see what happens. Now, from a trading perspective, obviously, if it can break above this resistance and it can pull back and stay above that trend line, that would be a very strong bullish signal. So that's where you could add a lot more aggressive long trades. But of course, always with a stop loss if you're trading short term. And if it hits that resistance, it can't break the resistance, and we see a bearish candlestick pattern over here, then that tells you that, well, it failed, it's coming back down again. So as a trader, again, the moment the price action proves you wrong and it shows that it's coming back down, that's when you can short the market. So there are many ways to short the market. You can simply short the underlying S&P ETF. You can buy inverse ETFs. But the risk with shorting is that if the market suddenly gaps back up, you could lose a lot of money. That's the risk of shorting. So when I want to short the markets, I want to have limited risk. So if the market keeps going up, I lose very little, but if the market collapses, I make a lot. And the best way to do that is using options. That's right, option strategy. So you guys who are in our options community, you have taken our options courses, you know that there are many option strategies you can use to short the market in a way that even if the market reverses back up, you lose very little. But if it goes back down or it goes down, you can make a lot of money. So for example, you can use bear put spread option strategies and a lot more other strategies that, again, we'll talk about within our private community on Discord. What else is different? Now, what else is different is also a couple of interesting things, right? Now, you guys may have been hearing a lot in the media or even on social media that right now the put-call ratio is at an extreme high level. So the put-call ratio measures the amount of put options versus the amount of call options. So when there are more put options than call options that are opened by traders, it tells you that the market is more bearish, okay? Or rather, people are very bearish. So you can see that right now the put-call ratio is at 1.07. It is at the highest level in 20 years. 20 years. So the last time it was this high was here, right? Back then, this was back in 2003 when it was really that high. It was very high here as well and very, very high here as well. So when the put-call ratio is very high, it tells you that retail investors are very, very bearish. They think the market's going to crash, right? And this is often a contrarian indicator because when everyone thinks it's going to crash, what does the market do? The market tends to go the opposite, right? Market tends to go opposite of what the majority think in order to screw the majority. Remember that the market is never obvious. It is designed to fool most of the people most of the time. That's what Jesse Livermore, the legendary trader, said. So if you look at past periods when the put-call ratio was very high, it was very high here, people were very bearish, what happened? Market went up. Very bearish, what happened? Market went up. Very bearish, what happened? Market went up. Right? So this is one contrarian indicator to tell you that the market could still be going up because of this. All right. Next, if you look at the Association of American Investors Bull Ratio, this tells you how many retail investors are bullish. All right. So the higher, the more bullish, the lower, the less bullish. And we are at, again, the second lowest level in 20 years. In other words, retail investors are very, very bearish. They think we're going to die. They're all very fearful, right? So again, the last time it was so low was back here. back here in the 1990s. Now again, this is again a contrarian indicator. When most retail investors are very bearish, market tends to go up and screw everyone, right? Market goes opposite of everyone else. So again, check it out. When the bull ratio is very low here, right? Very low, market bottoms, right? Very low here. Okay, in this case, the market still went lower. So I mean, it's not a perfect signal. Could still go lower, right? Bull ratio very low, market bottom over here. All right, bull ratio very low, market was near the bottom over here. So again, no indicator is perfect, but more often than not, when the put call ratio is high and the bull ratio is low, markets tend to keep going up, right? So again, is it a guarantee? Will it definitely go up? No, it's just a probability. So we always have to wait for the price action to confirm what we're going to do, all right? So again, remember, what you do really depends on your investing plan and your trading plan. Now, I've said this many times before. If you are investing for the longer term, if you're a longer term investor, you're holding great companies for the next 5-10 years, this shouldn't bother you at all. So for my investing portfolio, whether or not it breaks above that resistance or it comes back down, it doesn't affect me. Because I'm not selling. I'm continuing to hold my great companies because I know in the long run, they are always going to go up eventually, right? But you say, but Adam, if it's going to reverse lower, why don't you sell your investments? Just sell and buy back even lower. That sounds great, right? I mean, that sounds great in theory. But the trouble is many times, if you're investing in great companies, you know they're going to go up eventually. And the danger is if you sell, hoping to get back lower, what if it doesn't go lower? What if it goes lower a bit and reverses back up and then it goes off without you and you're not in the markets? So I keep saying that as an investor, people always talk about the risk of being in the markets. Or what if it goes low? What if it goes lower, right? But to me, the bigger risk is being out of the markets. Because if you're out of the markets and the market goes down temporarily and goes up eventually, you're not going to be in the market, and in the long run, you're not going to build your wealth. You're going to lose out in terms of inflation. Does this make sense? So let me give you two analogies. The first analogy is this. Let's imagine the market is a bus, right? And your destination is financial freedom. In the next 5-10 years, you want to build your wealth to achieve financial freedom. Now, if you pick the right bus, in other words, you bought the index or you bought fundamentally great companies, you know that the bus would eventually reach your destination. It will go there eventually in 5 years, 10 years, whatever it is, right? But the trouble is the bus doesn't go up in a straight line. As you know, the bus, sometimes it goes up and it may make a detour to pick up more passengers, right? And then go pick up more passengers. So it may make some detours, this bus, but eventually it's going to go up, okay? So if your goal is to be financially free, if your goal is to reach the final destination, the best thing to do is to stay in the freaking bus and not be afraid of detours. The trouble is people are impatient, right? And they think, okay, the bus is going to detour, it's going to detour, right? So they thought, I'm going to jump off the bus, let it detour, when it comes back, I get on the bus. But the problem is very often when you get off the bus, it's very hard to get back on the bus. Many times the bus will suddenly reverse and go up, go north without you, all right? And so it's very, very dangerous as an investor. As an investor, I just want to stay on the bus and not risk the bus driving off without me, okay? Now, let me give you another analogy, right? The analogy of, let's say, a relationship. Now, again, as an investor, you're only investing in the fundamentally best companies in the market, great companies. It's kind of like, you marry a great person who has got a great character and all that, and you know that in the long run, your marriage is going to be fantastic, right? But in the short term, your spouse, who's a great person, may go through mood swings. They may get bad mood in the short term, right? So what should you do if your spouse is in a bad mood? And you know that they are a great person, it's a great marriage, just in a short-term bad mood. You should stay with them through the ups and downs and console them because eventually you're gonna work out, right? stay with your investments. The trouble with some people is they think, okay, my spouse, my wife is in a bad mood. I'm going to avoid her, go to the pub and drink, all right? Avoid her bad mood. And when, I wait for her to be in a good mood and I come back and be with her. It's like getting out of the markets and hoping to get back in when the markets go up, right? The problem is, by the time you come back, your wife would probably be running off with your best friend without you, okay? So that's why I say, as an investor, so whether it's going to go up right away or it's going to make a detour, all right, as an investor, I'll just stay on the bus. I'll just stay on the bus. But you may say, but Adam, if the market goes down, aren't you concerned? No, because it's going to go up eventually, right? But again, as it goes down in the short term, from my trading portfolio, I can make some good money as it goes down by, again, shorting the market, shorting specific stocks using a lot of different option strategies. So I can have the best of both worlds. I hold on to my good companies through the ups and downs, but in the short term, I may short the companies using options so I can make some money as it goes down temporarily. Now, so far this year, this bear market has been caused, again, not because of recession, not because of earnings contraction. This bear market is caused because the Fed raised interest rates too fast, causing the 10-year yield to rise too fast and hence causing the bear market. The good news is that, in my opinion, this is over, in my opinion, because I think that inflation has peaked. I think that the Fed is not going to raise rates as aggressively anymore, and the 10-year yield is now breaking down. So because of that, in my opinion, the Fed and the high inflation is no longer the reason for the market to go down anymore. And so I think that for this year, for 2022, we have already bottomed. We are not going lower in 2022. However, in 2023, could we go lower? Could we continue the bear market for another reason? The answer is yes. And the only other reason that the bear market may continue in 2023 and make a newer low is if we have a recession and if we have earnings contraction. So what's the probability that the US economy will go into a recession next year in 2023 and the stock market will go down even lower? Well, find out in my next video. So remember to subscribe to get part 2 of this video. A reminder that all my courses and playbooks are going for up to 75% off for a very limited period of time. So go on to piranhaprofits.com and grab your favorite courses, whether it's a stock trading course, the value momentum investing course, the option courses, or the price action manipulation courses that's going to give you the skills and knowledge to succeed in today's markets, and join our private community of traders and investors.